everyone. Thank you so much for joining us. I'm Lucy Brewster. I'm a finance reporter here at ETF.com, and today we are going to be discussing all things ESG and sustainable investing and how it has involved and will continue to. I can see panelists joining. I can see participants joining now. So thanks again. We have an awesome group of panelists here. We are going to be diving into this really important but complicated topic. We'll be talking about ESG funds, how they're structured and how they operate, as well as how both financial advisors and investors can create a portfolio and structure their investments around their values and what's important to them. So I'm just going to introduce all of our great panelists here. We have Paula Glick, who is the co-founder of Honeytree Investment Management, an asset manager focused on responsible growth. And prior to founding Honeytree, she was the vice president of MSCI ESG Research. Chris Hackel is head of sustainable index products at Bloomberg. And that team at Bloomberg offers cross-asset ESG and climate indices, as well as a whole research team. And Jonathan Shenkman is the president and chief investment officer at ParkBridge Wealth Management, where he helps clients achieve their financial goals, including around value and impact investing. And I just want to start off for everyone listening and watching with sort of an overview of what ESG is and how it works. So, Paula, I'll start with you. Can you just give us an overview of the definition of what ESG investing is and what the framework can offer investors?
Sure. Thanks, Lucy, and thanks for inviting me here today. Yeah, ESG, ESG is I wouldn't say a newer term. It's been around for a while. It means environmental, social, and governance, and referring to factors that we use to assess the sustainability of companies. And, these sort of three pillars were created by companies that started to create ratings. And ESG, just for some history, was in my experience over the evolution of time, came into effect. It was more of a neutral term that was adopted around the time that the United Nations-backed Principles for Responsible Investment came into effect around 2005, 2006, because it was more neutral in that at that time, there was an understanding, there was an adoption by the institutional investment world, i.e. pensions and so on, that ESG factors can be material and thus impact on risk and return. And so there was a whole fiduciary legal positioning that took place. And so ESG represented that neutrality. Before that, it was actually called socially responsible investing, which has a very strong values side to it. And then it became responsible investment. And people like to sort of dissect them and say SRI was in the world where we just use negative screens. RI became more when it was like positive and negative, and then ESG and so on. But the fact is all of these terms, even today, we use the word sustainable investing. People are always trying to find something that aligns with their comfort levels and how they like to talk about the issues. But anyway, so broadly speaking, folks that like ESG products really care about three things. And so ESG has always been about, so I would say three things. Financial performance has been a number one key issue for folks that want to invest in in ESG products. They also want to align their investments with their personal values. And so those two things together have been like the bulk of time. And then more recently, the notion of positive impact. And so folks want to invest in things where they feel they're actually creating a positive impact in the world. How can we actually contribute to positive initiatives in the world? And ESG products, like there's so many different types of products out there. There's so many ways to slice and dice it. On the most simplistic basis, a product can be defined as ESG simply by avoiding one sector, tobacco, But really, if you look at it, there's many more sophisticated types of products out there and across a whole range of passive, active, concentrated, best of sector, and so on and so forth. And I'll just talk very briefly about Honeytree, my own company, and our view on all of this is all three of those key concerns: financial performance, values, and positive impact we're keenly aware of all of them and try to integrate all of that in. Those are all of our objectives. And so we've created a very, designed a process that's very selective, high conviction, and concentrated to find the best companies. We're focused on what we call responsible growth, but it's really about stakeholder governed companies, companies that are purpose driven, and that have kind of this notion of shared value, that they're providing positive impact for society and also for shareholders. That the impacts that these companies that we're identifying are companies that understand that the impact that they're making on their employees, their clients, the community where they operate, the environment, and their shareholders, and their business as usual is what's driving the bottom line. It's a complete perspective. And so that I think all of the funds and the different ways that folks can do it, it's important to understand the different approaches, the different methodologies, looking under the hood, to really understand but those are the key issues.
Yeah, absolutely. No, thank you for that. That context is super helpful. And Chris, I want to turn to you because, as Paula mentioned, I mean, there's a lot of funds and a lot that is sort of in the ESG family or under the umbrella. So, could you speak a little bit to how on your team you design ESG and sustainable indices?
Yeah, absolutely. And I'd start off by paraphrasing a saying, which is sustainable indices are like every other index, only more so. And what I mean by that is that from a high level perspective, our design approach when it comes to ESG or sustainable indices, it's the same as with any other index. Our goal is to create rules-based, objective, transparent benchmarks. You can use them to measure performance, to assess risk characteristics of various sustainable themes, and of course, to also create passive or index-linked funds or products based on them. But the challenge comes is that there's been this proliferation of different sustainable themes. There's been a proliferation of data sets as well as approaches to integrating that data into portfolios or into indices. So when we think about designing these indices, it really comes down to three key questions. The first is, what are the main objectives for the index? So for sustainable indices, you have both financial as well as sustainable objectives, and you really want that sustainable objective to be clear, understandable, and very specific, and ideally to also be measurable within the index. So that's the first question, what are the objectives? The second is, what are the constraints? So there can be policy constraints, there can be things that need to be excluded, and there can be just normal constraints in terms of if it's a fixed income index, sort of maturity bands or developed or emerging markets. So there's constraints are the second consideration. And then finally, what are the desired risk exposures? So starting off with objectives, and this is gonna, I think, reiterate a lot of what Paula said. She highlighted a bunch of these. There's again a ton of different sustainable objectives and approaches out there, but I think you can divide them, if you want to be simple about it, into values-based approaches and value approaches. So when we talk about values-based approaches, there is a significant segment of investors that want to include either their values or environmental and social impact considerations in their allocation decisions alongside returns. So that's a key thing, is when people are looking to incorporate these values or environmental, social considerations, returns still do remain an important factor, obviously. But these are an additional consideration that they want built into the approach. The simplest example, again, that Paul referred to before, and that sort of has the longest history when it comes to quote unquote ESG approaches, is implementing exclusion. So a lot of investors, they don't want to make money if it means people are smoking more, for example. So tobacco has been sort of a long-standing exclusion that people have had on their portfolios or investments. And I'd say that's the longest use of quote unquote ESG. Other investors want their investments to sort of promote either environmental conservation or social equity. So again, those sorts of considerations alongside those financial objectives. So that's speaking to the values based perspective, but other investors are incorporating these sustainable considerations from more of a risk assessment or performance lens. And by the way, there's not necessarily, those two things aren't mutually exclusive. You can have values-based considerations that do play out in terms of performance and risk characteristics. And here I'd say the most common use historically, or the most widespread use historically, has been integrating ESG scores into either indices or portfolios. So as again, Paul mentioned before, ESG scores are, most of the ones that are available in the market are meant to be financially material measures of risk and opportunity. So for example, they're meant to assess the risk companies face based on, it can be regulation, it can be reputation, it can be the fact that the planet's warming, resource scarcity, new risks that are being created in the world, and then how they play out in terms of a company's bottom line. So ESG scores have been, I'd say, the most widely used, but more recently, climate has really come to the forefront. So we have this global transition underway to a low carbon economy. This is creating new risks and new opportunities, and investors want to consider these in making their allocations decisions. So that was step one, right? We want to set our clear and specific sustainable objective. It's a critical first step. Beyond that, there's other considerations like asset class considerations. So is your approach in equities versus fixed income, is it just going to be the same? Now, in equities, you can hold on to a company that you might not be happy with, but there's an engagement opportunity. So you can influence their behavior. Fixed income, you're funding the company's activities. So you have to be more sensitive to, if this company is doing something that you don't approve of, you don't necessarily want to fund that activity. So you might consider excluding it there versus engaging on the equity side. There's also risk considerations. So when you implement either of these exclusions or tilts, et cetera, you're going to have deviations from a broad-based benchmark. You're going to see changes in active sector weights, changes in duration, things like that. And you have to decide whether you're going to control for those risks or not. In terms of implementing these indices, I say there's four most common approaches. There's exclusion approaches, where you just say, whether it's business involvement, again, weapons or tobacco, et cetera, I'm just going to take it out of the index, or fossil fuels. There's tilt approaches, where you can take a factor like an ESG score or another type of climate metric and just shift the allocations in the index for higher allocations to companies that are performing well and lower for the ones that aren't performing as well. The third approach is thematic baskets. So you can just take a basket of companies that, for example, if you want to invest in renewable energy, hydrogen, or other types of themes there. And then finally, the fourth approach that we've been seeing very commonly, much more often than we used to, is optimized approaches. And the reason that we're seeing a lot of our clients interested in creating optimized sustainable indices is that they want to improve some of these characteristics. They want to allocate into companies that are reducing their emissions or have high ESG scores, but you want to control for other risk characteristics. So when you use an optimizer, you can control for tracking error, you can control from deviations from your broad-based benchmark, and you can have something that performs very much in line with a broad-based index while also improving some of those characteristics that you want to improve.
Yeah, no, that's great. I mean, I think that is really helpful, because I think when a lot of times people talk about ESG ETFs or ESG funds, it's sort of all in one category. But as you mentioned, there's not just one approach to how different indices and how different funds use ESG. But I want to shift now, because I think a lot of people listening, a lot of our audience knows that there's been, in a lot of ways, there's sort of trend cycles that investors go through, and ESG was sort of a big one a few years ago, and now we're seeing a lot of these ESG labeled funds close. We're seeing some outflows from a few of those ETFs, and I want to hear from you, Jonathan, because you've been working with clients and sort of going through this with them. How have you seen demand for ESG evolve over the last few years, and sort of why do you think things have changed?
Yeah, and thanks so much for having me. So first, I should say that in my practice, I work almost exclusively with private clients, oftentimes multiple generations of one family. So my experience may be vastly different than folks who work with institutional investors. But I'll share what I've noticed from my vantage point. So when onboarding new clients, I always ask if they have any special considerations before investing. This can be anything from excluding certain stocks or certain sectors, various other parameters. It also implies whether the client wants an ESG focus, but could be anything that the investor is passionate about. And it was common around 7 to 10 years ago, where I actually had a fair amount of interest from clients regarding ESG funds. And I actually remember one client saying to me, if I could implement a strategy and seamlessly use ESG-friendly products, why not just use ESG funds for every single asset class? And this occurred quite frequently, where clients would prefer implementing a strategy using ESG funds. However, to answer your question on my practice, this has changed in the past few years. My existing clients and new clients have seemed far less enthusiastic about traditional ESG funds for several reasons, which I'm sure I'll get into. In fact, an existing client reached out to me a couple of weeks ago. He had a liquidity event and had some capital he's looking to put to work. And unprompted, he told me that he didn't want any of his money invested in ESG products. I didn't even mention ESG to him, yet he felt strongly enough about wanting to avoid ESG funds that he actually made the point of telling me to avoid it, which I thought was interesting. I'm happy to expand on that about the different types of funds and why people have soured on it as well.
Yeah, I thank you. And, that sort of reflects some of what we're seeing in terms of outflows from some of these funds. And, definitely, especially in the US, I should say specifically, because it's different in Europe and other places, there's been a lot of political backlash to ESG, which aligns with some, conservative backlash against climate, from top level climate regulation on the government level. And then there's also some concern about sort of this idea of greenwashing or investors paying too much for some of these ESG funds. And I would say those are what we hear is two sort of baskets of concerns people have. And I kind of want to, hear from you, Paula. How do you feel in terms of coming out with a ESG ETF? It's Honeytree Equity ETF, ticker BEEZ. How do you sort of navigate the political climate, and sort of how do you respond to some concerns as you see them?
So, I mean, I've been in the ESG space for like about 20 years. So I've seen a lot of the evolution. I mean, we've never seen the political backlash that we've seen of recent, up at the presidential nomination level, talking about, this anti-woke kind of thing, which I think is rhetoric that they know will, sort of innerve their base. I think there are a lot of issues and pushback, and we've seen a number of states now enacting regulations to discourage state pensions or prohibit them from considering these things. But I've always the ESG world has always had skepticism along the way. And it used to always be more focused in the investment fiduciary responsibility. Are you going to impact negatively on returns? The pushback today, seems to have risen to a political level. But Honeytree, one of the reasons we started this company was that we could take a consistent approach. We actually, we don't brand ourselves per se as ESG. I mean, in everything that we write and everything we think about. But our Honeytree ETF is the U.S. equity Honeytree ETF. It's not, sustainable or anything like that, because we actually believe that these issues are material, or can be material, and they're really just additional fundamental data. And so really, to us, it just makes perfect sense that you would be including these things, looking to them. And I do think that they absolutely should be mainstream. I think companies themselves have long realized that in order to have a really successful business, of course, and the bigger you get, but even as a young company, that those companies that understand the impacts they're making, that across all of their stakeholders are going to be more successful. Operational efficiencies save the company money. Initiatives on the social side that bring loyalty and productivity and less turnover. Those things, cost the company money. Saving on all sorts of environmental things that obviously have reputational positive or negative impacts. Yeah. But all of that relates. So I think, it really depends. I think the people that have been mostly impacted and why, some of these funds, have closed and so on. I think, again, it should be very mainstream. I think the larger firms that have more to lose in terms of billions of dollars being removed, like the Vanguard and the BlackRocks, who've sort of steered away from the Net Zero Alliance, for fear of losing big bucks, they're the ones. And Honeytree is interesting because we're a pure play ESG kind of shop, whereas a lot of the larger managers have managers have mainstream product, and then they have like their little ESG family over here, and there's a disconnect. Yeah. And it sends a lot of confusion out into the marketplace when people look at the different holdings or the very similar holdings, trying to make sense of it. So I understand. And of recent, there's been a lot of pushback on DEI because it's, in some ways it's been, misused, I think, but the liberal values of what DEI stands for within the company perspective are core to the success of the company. So those are my thoughts.
And I would just add to that. I think one of the big challenges with ESG, and it kind of goes back to what I was saying before in terms of having clear and specific sustainable objectives. I don't think that it was effectively communicated to the market what ESG scores are meant to do when you integrate them into a portfolio. I think there's a lot of confusion around, does this represent companies that are doing more positive things for the environment, more positive things for society, or does it represent just different types of risks that companies face, again, in a world where temperatures are getting warmer, there might be water scarcity. And so it's the latter, I think, generally. Again, these are measures of financial materiality, and I don't think that was ever really made clear enough to the market. And ESG scores by their nature are just also very easy to criticize. I've yet to hear any sort of pundit or politician accurately describe what ESG scores are, and it's because they incorporate a lot of different factors, and they are material factors. But if you just kind of look at them all bundled sort of kitchen sink into one thing, it's very easy to criticize that and to call whatever you want to call it, and you're not going to have people arguing with you because there's just that lack of a detailed understanding of what they actually are. So, for example, one of the things that we're looking to do now is sort of de-aggregate that score more to pull out sort of key issues that are most relevant to certain types of companies. So, for example, you have either a beverage company or you have a mining company that has a high dependency on water. Now, if water scarcity is going to be a theme going into the future, that's a clear risk that you can point to. So again, I think when you kind of bundle these things all into just one evaluation, it's a little more challenging to explain it and explain what the impact on performance or risk is going to be. But if you kind of break that apart a little bit more, the theme becomes a lot more clear.
Yeah, I think one of the things about ratings and that's been controversial, as you've just said, is that the reflection back to how it affects the company, right? Due to regulations, how it's affecting them in terms of their own performance and ability to achieve their goals, rather than thinking about the potential impact they have on the world or on the planet, on society. And so it's about sort of merging those two things. But ratings have their own issues because they've created their own methodologies that aren't the only way to look at things. And in fact, I mean, they never looked at racial data as an example. They didn't look at diversity beyond gender, partly because it's very hard to collect that data, right? But I think that as part of understanding governance, you want to look at diversity far beyond just gender, to look at all sorts of things, and to to be able to better assess. And there are other examples of more non-mainstream considerations that aren't incorporated into those ratings. And the ratings have to cover thousands of companies, so their data, is not always the most relevant at all times.
Yeah, no, that's really interesting and all great points. I'm curious, sort of along this topic, do you see, in terms of what you think going forward would be, sort of the best in terms of investors understanding how ESG works and understanding sort of the risks and how it can fit into their portfolio? What do you think could sort of be, move the needle in terms of kind of moving forward, moving past some of these misconceptions? Do you think that, maybe the term ESG is, has too many misconceptions associated with it, and people should think more about, climate investing as its own issue? Like, I guess I'm curious your thoughts about, how you think about the education aspect with investors.
Well, I would say, first of all, the term is gone. I mean, I think maybe it's still being used by some people, but what I've seen broadly is that people are saying more sustainable. My team's a sustainable index team, and you're seeing that more and more with asset managers as well, to kind of move away from that ESG branding. But in terms of what comes next for it, yes, I think there is a lot that needs to be done in terms of demonstrating the materiality of incorporating the factors and explaining it better. Fortunately, regulators are doing a lot in this area. So particularly in Europe, but also the SEC has been working on some things in terms of new labeling schemes that themselves will help provide a lot more clarity in terms of people understanding, well, what is this actually meant to do? And then disclosures around that, regulatory required disclosures that, again, explain exactly what are the factors that are going into this, what is the objective that it's looking to achieve, and providing the clarity that way. But beyond that, I still think that there's a lot that needs to be done just coming from financial market, these financial market industry to help educate more.
Yeah, no, that's interesting that the ESG term you think is kind of just being sort of going on its way out. I've heard that too. Yeah, but that's interesting. Paula, were you gonna add anything?
Well, I mean, for us, the idea that, we actually built our process to actually not incorporate E, S, and G as pillars.
Yeah.
We intentionally designed our structure so that our thinking around our investment decision-making process is financial, environmental, and social, all combined in different pillars of leadership, competitiveness, risk management, you name it. And we've designed it that way so that so that the portfolio management team can think about these things in a more inclusive way. I think some of the problems with the whole ratings world is that they siloed the process. And so people over here, portfolio managers, tend to look at the financial side of the equation, and then you've got your ESG team over here, or your ratings. But it is that underlying data that I think Chris was mentioning was really key to us, is that we don't look really at the ratings, we don't really look at all of the underlying data. We look at a core component of data that we think is really important. And as I mentioned, for us, it's fundamental data. So I think that, the way forward is mainstreaming. It's nice to have these defined, but I think, most people and so many managers are in some capacity, just maybe not systematically looking at environmental social issues. Some sectors will lend better to it. For us, it's just crucial for understanding. Back to the environmental side, like we never wanted to create products that were tilted, thematic, like the environmental side. The environmental side is key, but all of our companies need to do all of it, right? And obviously they're going to be stronger in some areas than in others, but I want a holistic approach. Over the years, seeing these different products, I was scratching my head. Well, yeah, but their governance sucks. They have so many controversies on the social side, but environmentally they're doing something cool. It didn't resonate enough. I needed to see companies that got it, from the big perspective, and we're working on all angles to create systems change. And so I think you can have an environmental play while at the same time having social. But one of the ways that you can do that, of course, is really when you build a very selective approach where you can get down to the nitty-gritty and be very picky about the companies that you own.
Yeah, absolutely. And I'm curious, Jonathan, from sort of the individual investor perspective, when you're working with clients and they're not interested in ESG labeled funds, what do you do to work with them to still sort of build a portfolio around their values? And how do you think that that's evolved in the last few years?
Well, I think it might be first better to discuss a little bit why my individual clients have soured. And I think some of the points that Paula and Chris have mentioned may be part of that. From my perspective, I don't care. I'm not encouraging if a client to be ESG or sustainable focused or discouraging them. My objective is purely just to get them to build a plan that's sensible to achieve their goals and then to stick with it over the long term. And I think the primary reason, and this will play into some of the things that I've done to implement strategies for clients, is clients really desire more control. It's not that many investors are anti-ESG. They just believe, and correctly so, that no one can implement a strategy to align their personal goals and values better than themselves. And the main reason for this is ESG funds for retail investors are mass marketed products for the most part. Not everyone has the exact same preferences, and clients have expressed that buying into an ESG strategy is built for the masses, which may not be customized enough for a client's specific preferences. In a way, I thought that a good analogy was just similar to target date funds. For many 401k investors, a target date fund may be a satisfactory option. However, target date funds are built to cater to the masses. If an investor leaves their employer, oftentimes they're going to roll over that 401k money to an IRA where they can customize their strategy and more accurately reflect their needs within their IRA accounts, which they couldn't do within a 401k using a target date fund. And I think this desire for more control applies to sustainable investing as well, where many clients are not interested in this lack of customization through traditional ESG products. And I think this desire for more control, again, is really the main reason some investors may have soured. But there are other reasons as well. Another one, which Paula brought up, is some clients have found the ESG methodology perhaps a little bit confusing. And I often get the question, why are environmental, social, and governance criteria all grouped together when they're pretty distinct measures? There's also some confusion on the methodology of ESG. Why are certain securities selected for a portfolio where others are excluded? One example off the top of my head, a client asked me, he made the argument that Amazon is not a true ESG stock. I have no opinion on it, but he said Amazon rates highly on corporate governance. I believe it has an average carbon footprint and scores poorly in labor management. So that was another issue. There's another factor which I actually thought was pretty interesting, which someone said they felt that ESG was unnecessary in today's world. And their rationale is that for a company to be successful in today's world, there are certain things they need to do. This includes respecting, at least in the United States, respecting the environment, treating your workforce and various stakeholders well or reasonably well, and having proper governance. The thought here is that you can use a traditional broad market weighted index fund, and the companies that will be the most successful are the ones that naturally uphold ESG principles. Yeah. They argued that special screenings are actually unnecessary because of this. And the last one, which Lucy, you mentioned in kind of your intro, was there's greenwashing. Greenwashing is where ESG values are discussed or highlighted primarily to sell a product or strategy, but they're not actually upheld. Again, I want to reiterate that these are items that are all observations. in discussions with my own clients. I didn't actually do a large survey of investors. So this is something I personally noticed from my own interactions. And I'm happy to go into how I implement a kind of a little more of a value-based approach.
I just wanted to comment quickly on this. Some of your points are very interesting and very good. The market cap side of the equation, I think one of the major confusions with ESG products and where there is potential for greenwashing and why the SEC and why it's becoming more and more important for prospectuses to actually have detailed information on what companies' objectives, what investment managers' objectives are, what they're trying to achieve, and how they're as much information as they can to share in how they're doing what they're doing. It's because when you create a product that is so-called ESG, but the overlap with the mainstream market cap index is so similar that everybody's holding the same Magnificent Seven, how do you differentiate, right? It's like, well, what is the difference between this product and that product? And therefore, that creates that confusion. And I think that, so it's not, the criteria, it really comes down to the manager and their notion of what is really driving sustainability in that approach. I think it's just important to understand that, and I understand like that confusion. You know what I mean?
Yeah, absolutely.
Yeah, absolutely. No, that totally makes sense. I'm curious, Jonathan, how you work with clients to sort of navigate everything you mentioned and sort of what is working for people now from your perspective.
Yeah, so there are three frameworks of impact investing beyond ESG that have come up in my practice. I don't know best way to label it, but this is kind of the way I titled it. The first is religious, which I think may actually predate traditional ESG funds, and that's excluding certain investments because they're not in line with investors' religious values. Next is investing based on personal ideals. So I have clients that are passionate about investing or divesting from countries based on upholding proper working conditions for employees, democratic values, LGBTQ and women's rights, and other issues that they're passionate about. And lastly, and this is more to the financial planning side, it's preserving family values across multiple generations. Sometimes when working with generational clients, there's a theme or multiple themes that a family feels passionate about and are important to them based on personal experiences. In these scenarios, I'll structure a strategy that adheres to upholding these values for several generations and just for one family. And I can obviously provide some more detail on these points and specifically what scenarios that have come up or that I've implemented for clients. If you want, I could keep going. So,
yeah, that's great. No,
I don't want to monopolize the conversation. So
no, not at all. That's really interesting. Well, I am curious a little bit if maybe you could give an example, and then if you see this as something that is a sort of growing framework, or you're hearing other financial advisors use it, or if it's something that individual investors can kind of do to some degree.
I mean, absolutely. I think individuals can do it. And in terms of it's a growing framework, I think Chris probably could speak better to this because he works at Bloomberg and they have all the information in the world. But in terms of there's movement in terms of whether others are adopting more of what I call a values-based approach and the three different frameworks I'm looking at, I do it. I think people that are in the wealth management industry, they're taking more of a holistic approach, and that entails setting up an investment policy statement or multi-generational investment policy statement with their individual clients and institutional clients, figuring out the parameters that make the most sense for them. So I think the idea of aligning a client's values with their assets and with their portfolio is something that is definitely gaining traction. How they implement it, I can only speak from my perspective in terms of what I do.
I mean, I would say from my side, first of all, I think that the vast majority of fund flows into sustainable, ETFs and other funds have been institutionally driven. Institutional investors tend to be rather sophisticated, and globally, it's not just a European trend, although we've seen the most traction, obviously, in Europe, but we have seen traction in the US as well. But globally, what we're hearing from institutional investors as well as from asset managers is that they are incorporating these factors from, again, a risk and performance lens. There are companies whose business models that are, high emissions companies, for example, whose business models are at risk if they're not making the investments now in transitioning themselves to either other products or other business lines. Energy is a good example, in transitioning into clean energy sources. And then on the opportunistic side, we see things like the IRAs, the Inflation Reduction Act from Biden, which is channeling billions of dollars into renewable energy and infrastructure around this, and that's creating opportunity. So there is the value side of this, and that I'd say probably is the way most people think of what most people think of when they think of ESG. But
Yeah.
there's, you know, the risk component and the opportunity component are equally as significant, I think.
Yeah.
I think they're all combined. For us, it's, you know, our clients are the ones where all the boxes get checked. You know, it's not like one thing or the other. It's all of these things work very well together. I mean, obviously you have to have a good investment process that's going to ensure as much as possible that there's some, you know, alpha, right? That's for us, we went very concentrated active, because how do you distinguish yourselves from the index? And index like products are designed to perform like the index, close tracking error and so on and so forth, which the institutional pension world and so on, who are driving a lot of these things, are going to want. But, you know, for folks that want to have their cake and eat it too, and check all the boxes, is where, you know, a Honeytree type product can come in, where you've got your impact, you've got your adjusted risk returns framework, and you've got your values all combined.
Yeah.
And I think that's, you know.
Yeah. And yeah, we wanted to leave some time for audience questions too. And you know, one question that we got on social media that I kind of wanted to elaborate on is how can I invest in emerging climate tech? And Chris, I kind of want to ask you this in terms of, for people who are really interested specifically in investing in the green energy transition, they're excited about new climate technology, and that's kind of their focus. What opportunities do you think are really there for investors, you know, in terms of sustainable investing?
Yeah, I mean, the simplest way to do that, if you're sort of willing to have the concentration, I guess, in a specific area, is to look at thematic indices. So, for example, we have a wide variety of thematic indices that address renewable energy, clean energy, energy infrastructure, and other areas that are sort of on the forefront of the energy transition. And, you know, as I mentioned before, there are, you know, hundreds of billions of dollars that are now sort of being channeled into this area. Some of it is driven by regulation. Some of it is just part of this global transition into a low carbon economy. But, you know, that's where these opportunities are being created. And I think, to again, you know, Jonathan mentioned before, you can access these through broad-based indices as well. These companies are going to be in broad-based indices, or portfolios. But if you want sort of a more specific exposure to that, then thematic indices are a good way of going about that, and ETFs.
Yeah. In general, I'm curious to hear from all of you in terms of how your optimism has sort of shifted in the past few years, in terms of both advancements you've seen in sustainable investing, and, you know, now talking a little more specifically about climate. But, you know, do you feel like asset managers, Paul, I heard you speak a little bit about this, you know, a lot of huge asset managers, it seems from your perspective, have a long way to go, but how has sort of your optimism shifted about the landscape, or you know, not shifted? Yeah, Paula, I can start with you.
Well, for me, I mean, the optimism lies with the companies themselves. The industry needs a lot of room to grow, for sure. You know, I speak to, you know, colleagues of mine, you know, who are working in the large banks. You know, the processes that we're seeing, that I saw back in the day, are still very much alive and well. The so-called notion of integration is not really taking place in many respects. But I would say that my optimism lies in what, you know, the ISSB, the International Sustainability Standards Board, is doing. Some of these interesting international initiatives, such as science-based targets. You know, really, like, you know, so much of the publicly traded companies out there have sort of announced net zero goals, but what does that really mean? So, you know, it's really about organizations that are able to assess and approve companies' real targets, you know, assess them and say, you know, this is valid. You can achieve, you know, this goal by X and Y, and then watching companies actually year over year changes. When we started our company in the end of 2018 to today, we've seen so much more information available. Companies are getting so much better at disclosing, being transparent. They get it. They understand the value. They're not really fighting this. They're actually interested, because they understand that it impacts on their business in a positive way. There's, you know, it's much more than renewable energy, right? It's much more than than the gadgets. It's about the clothing we wear and how to like improve on the different materials, the chemicals that we're using, the packaging, the plastics, the shipping. How do you build better systems so that you can actually save on emissions, save on money, better the planet, and do good by the company, all of that combined. So there's so many different ways to think about it, and there's so many companies that understand in their operations are actually driving those changes, that through their supply chains, through their product, as well as in their suppliers, and how they're working with interesting tweaks that are making huge impacts. So that's where my enthusiasm lies.
Yeah, absolutely. And then one question we have, and I'm sure there's not one answer, but I'm curious what you all think, and was why have ESG funds underperformed a lot of their non-ESG counterparts? I don't know if anyone wants to jump in, Chris.
I mean, it's a tricky one because it depends a lot. If again, you can ESG score shouldn't result in sort of biases against sectors because they're meant to be neutral within a sector. So you're not saying, for example, that you don't say with an ESG score that a fossil fuel company or a tobacco company is bad. Actually, you just consider them versus their peers. So you shouldn't be making any very significant active sector bets based on using just the ESG score. I think what people see is that a lot of funds and approaches in the market, in addition to using the ESG score, will also, for example, exclude fossil fuels. And if you exclude fossil fuels, again, that can be either a values-based decision or a value-based decision if you think that, eventually these companies are going to have a tremendous amount of stranded assets and, they're not going to be able to monetize those. But if you do exclude those, and there's going to be short-term things that happen that create a lot of volatility in performance. So, what you can do is you can either decide to remain broad-based, to allocate broadly across sectors, but then just try to make those distinctions between companies within those sectors so that you don't completely change your allocation versus a broad-based benchmark, or you can say this is the bet I'm making and go all in, and that's what you can do as an investor. There's risks associated with that, but you can choose to accept them or not.
Yeah.
Okay. I was just going to say, just from my perspective, the performance for some of the ESG strategies is less important, at least from my perspective, than getting a client to actually stick with the portfolio because you've aligned their investment with their values and their overall arching philosophy. And I think that's, for me, that's the underlying theme of why investing based on your values or sustainable investing is so important, because if it gets a client to stay with their portfolio and stick with it and give compounding a chance to work, that's the ultimate objective. That's what's going to get a client to be able to achieve their goals. I also wanted to weigh in on the question before to Paula, just kind of what I'm enthusiastic about. And it's not really focused on the climate or anything like that, but the landscape for investing in ESG products, sustainable products, or implementing your values in any way. The investment landscape has been democratized where anybody, regardless of level of wealth, could have access to an infinite amount of strategies. You don't need to be necessarily an institutional investor. I mean, I'm sure there's some advantages to that, and you could get a little more customization. But whether you are a Muslim client and want Sharia compliant strategies, it's there. If you want to support democratic values in certain areas of the world or countries that have LGBTQ rights, like in Israel, I've had clients invested in there, and I've had people invested based on if they have a specific drug that they're passionate about, or area of the pharmaceutical industry because someone in their family has had some type of terrible disease and they want to show support for research in that type of area. They can invest in ETFs, individual securities, and private market opportunities, all to support that type of research. There's so many opportunities out there for all types of investors of different types and sizes, or shapes and sizes, to be able to access markets and implement a strategy to reflect their worldview.
Yeah, and I mean, adding to that too, people have to take into consideration that this is still a very brand new approach to investing. These are new considerations. I mean, in some regards, it's been around for a long time, but there was, I'd say, over the last 5 years or so, there was a groundswell of enthusiasm about it. A lot of assets flowed into these approaches without people really fully understanding them. And there's kind of a stepping back happening now. And that's coming from the regulation that's coming out, that's bringing more transparency and being more clear about the objectives. But the data itself is also maturing, and the ways to apply the data are also maturing. So this is still in its very nascent stages as an investment approach. So yes, there's going to be again, this sort of proliferation of options that Jonathan was describing, but the important thing is that those options are there and that people are able to understand them and what they're getting from them, what the actual result of integrating these factors into a portfolio or a fund are.
Yeah, those are all great points. And yeah, I was interested. There's one more audience question. I know this is another one that is not a straightforward, simple answer, but sort of from a regulatory perspective, is there anything you think, Chris, Paula, or Jonathan, is sort of the next step in terms of moving specifically climate, like the energy transition, forward beyond the Inflation Reduction Act?
I think there's two dimensions to what the regulation is looking to achieve. It's looking to get more information out in the market, so asking companies to disclose these factors so that that data set that you have to inform whether it's an ESG score or an ESG approach is more accurate and is actually coming from the source itself. So that's one side of it. And as companies start disclosing more of that information, then the scores are going to be much more representative, and there's going to be the ability to kind of use, again, accurate data coming from the source itself. So that's one side of it. And again, the other side I've mentioned a couple of times is just having the requirements for the asset managers, for the funds and ETFs, et cetera, that they're creating, to have disclosure around that. So to have the labeling, make it clear what the intention is, and then have all of the disclosures behind exactly what it's intending to achieve by incorporating these factors. So I think that those are two key components that are going to bring the type of transparency that will help people understand these approaches more.
Yeah, absolutely. Thank you. Well, sorry.
I was just going to say transparency and disclosure is absolutely key to making, to understanding the issues better.
Yeah, absolutely. Well, thank you all so much. This was an awesome discussion and we covered a lot. So I really appreciate all of your insights. It was super interesting, and there will be a recording of this on our website, so anyone can go back and watch it. And thank you again for all of our attendees for coming. We'll be continuing to cover the evolution of sustainable ESG value investing in our coverage on ETF.com. And thank you again to everyone. And yeah, have a great rest of your Thursday.
Thanks so much.
Thanks so much.
Thank you. Bye.
Thank you.